Inflation is the rate at which the general level of prices for goods and services rises over time. A moderate level of inflation is normal, but high or hyperinflation can disrupt an economy and even lead to catastrophe for its currency. Rates of inflation can vary widely, but are often grouped as creeping inflation. This is low, gradual inflation of about 1 to 3% per year, which is quite typical of a healthy economy. Galloping inflation is high, rapid inflation of 10% or more, often destabilizing and a sign of economic trouble. Hyperinflation is an extreme, out-of-control monthly inflation rate of 50% or more that can lead to currency collapse, like in Zimbabwe in the 2000s. Deflation is the opposite of inflation, where prices fall over time. While it might sound beneficial, it can lead to reduced consumer spending and economic slowdowns. Inflation is caused by multiple factors. Demand pull. This occurs when demand for goods and services exceeds supply, leading to price increases. Cost push happens when production costs rise, like raw materials and wages, pushing up prices for consumers. Built-in inflation, known as the wage price spiral, where rising wages leads to higher spending and thus higher prices, which in turn leads to further wage demands. Monetary policy. An increase in money supply by a country's central bank can reduce a currency's value if not matched by economic growth. So who is affected by inflation? Consumers face higher prices for goods and services, reducing disposable income. Savers can see the real value of their savings eroded, particularly if interest rates are low. Borrowers can benefit if they repay loans with money that has lost some purchasing power. Investors in assets like stocks and real estate often benefit, as these assets can outpace inflation. Pensioners and others on fixed incomes are often the hardest hit as their purchasing power declines. Inflation, particularly in recent years, is often seen as something purely negative. However, it does have some advantages. Moderate inflation encourages spending, which drives economic growth. Inflation can reduce the real cost of debt, which is beneficial for borrowers. Controlled inflation often signals a growing economy and rising demand. It can also help to push wages higher, improving overall standards of living. One of the responsibilities of central banks is to attempt to manage inflation. They do this by implementing interest rate changes. Higher rates reduce spending and borrowing, while lower rates encourage them. They will aim for an inflation target of around 2% as a sign of a stable economy. Central banks have tools available such as quantitative easing, where they may buy assets to increase money supply during deflation or low inflation periods, aiming to boost spending and economic growth. So, as an individual, how do you best protect yourself against inflation? First and foremost, monitor savings rates. Look for savings accounts that offer higher interest rates to minimize the impact of inflation on your cash. Consider investing in inflation-resistant assets like stocks, real estate, and commodities, which may all outperform inflation in a healthy economy. Inflation impacts everyone differently: consumers, savers, borrowers, and investors. But whichever category you fall into, there are ways to help guard yourself against potential negative consequences by understanding more about it. Thanks for watching.